Hey, welcome to the show, Total Financial Solutions. There you are, AM 1220 KHTS. Arif, follow me along with Jeff Girard every week at this time, talking about your family's finances, of course, getting out of debt, managing money, planning for your future. What's that all about when you're trying to plan for retirement under today's world where retirement almost seems impossible, really? It just seems like it may never happen, and even if it does, what is it going to be like? So let's go over a few things. First of all, in your retirement accounts, when you're ready to retire and start pulling money out, you've got to look at them being what they are. And look, they're pre-tax accounts. That means you've never paid taxes on this money. I just got off the phone with a client who says, okay, so you're telling me that I'm going to be paying income taxes on this money? I said, well, it is an old 401k. We rolled that over into an IRA, so it's your own money now. You don't have to worry about any fees that the 401k company's charging. And not only that, but here's your account and all of that said, and yes, you do have to pay taxes. If you never pay taxes before on the money, you don't get to never pay taxes on any money any time. What do you think?
Right.
The government has a sense of humor? Of course not. So remember this, your 401k accounts, when they were never taxed to begin with, you roll those over into an IRA, individual retirement account, which a lot of people over time seem to gather those because you may have 2 or 3 jobs or 4 jobs in your lifetime, maybe even as many as 2 or 3 careers. So as you do that and you kind of merge those jobs and those retirement accounts together, that now becomes your own individual retirement account. And with that being said, what does that do? It means that when you're ready to retire, you pull money out wherever you live, whatever your tax bracket is, whatever your situation is. That's what's subject to tax on your retirement accounts.
Well, a big part of this for me is I'm seeing so many people ignoring the part of the tax conversation. You know, it's something that seems like this mystical creature we're going to have to battle in retirement, right? We have taxes and healthcare are the 2 biggest expenses in retirement. Yet we're focused on, what's the right allocation and what are my fees and how much return am I getting this year? Really? That's fantastic. Those are details, though. Focusing on the contribution, number one, is the most important thing we think. The other part of it is to decide, do you do post-tax or pre-tax? You do have a choice. Some people don't even believe in retirement accounts. They say, I'm just going to park my money in a bank, or I'm going to buy a certain type of, okay, wonderful. That's wonderful. But if you're putting money into a 401k, you are automatically in business, in partnership basically with the IRS, with the government. So knowing what those ramifications are, what's going to happen in retirement for you, when you start to pull those dollars out, remember, look, it's really easy putting money into a 401k, and I put a hanging quote around easy. Before you even get a paycheck, your employer takes money out and says, before we tax you on this, we're going to put some in your 401k. And what does that do for you? That's a wonderful automatic savings vehicle. Your 401k at work, it could be a 403b if you're a teacher, if you work for a hospital, a research facility. You might work for a municipality, maybe law enforcement or a firefighter, and you have a 457. So all these codes are just basically the relationship that the government has with your dollars when you put them in and when you take them out. And those are very important parts of the component when it comes to saving for retirement, in my opinion.
So one of the processes of building your retirement planning is to remember that there's 2 big things that eat your retirement account. We have taxes, and the other side we have risk and fees.
Yes.
Now, why do I put those together? Because most of the time, in order to have fees or to charge fees, you also have to have risk. Now, risk by itself isn't always bad. You don't just say, well, that's a risky proposition to marry this woman. What if another one comes down the road? Well, I get it, right? We're like, God, that guy could be the best shot you have going down, or the next person that comes to the door. But risk with your retirement account means it goes up and down, and you have to think about this from a concept that if you're in your late 40s or early 50s, you remember the 90s. You remember the 90s when people were earning 20 and 30% rates of return. You remember the 80s when we were hitting 15s and 20% return. And then you remember the 2000s where within 8 years we had 3 bad years. In other words, out of 8 years we had 3 negative, where people lost more money at the end of the year than what they had at the beginning of the year. And we also remembered that these big financial companies had an infrastructure. Somebody has to pay for their electric bill, those CEO salaries, the benefits, the health insurance, the disability insurance, the company cars. Who has to pay for that? And if you were having a big bucket of dollars and you could fee those dollars, let's say at 1%, when we had massive declines 3 out of the last 8 years in the 2000s, when that dropped, they still had electric bills and CEO salaries and company cars. So what did they do to the fees? They had to raise the fees because the dollars that they were feeing were much smaller.
That's right.
And then what you had is when the market recovered a little bit, they never reduced the fees. They just kept them. They're like, oh, well, we'll put this as a rainy day fund. And that's why in 2008, when you had one of the biggest declines in the history of the market, it wasn't just the risk that reduced the value of those accounts. It was the 2, 3, and 4% or higher fees that some of these financial products were carrying. Look, I'm okay if you buy something and you receive it, right? If I go out to a nice dinner and it's a birthday or an anniversary dinner and I'm buying that dinner, it's a wonderful thing, and I want the ambiance and I want a great meal, I'm willing to pay more for that than when if I'm going out and buying a fast food hamburger. They both are called a meal. But you see, the difference is the foundation of that experience and what I'm buying, I'm willing to pay more for it. So if you tell me you're a financial professional, you're excited about them, they're great people, not questioning integrity, but you're telling me that those folks are charging fees, putting your money at risk, and when the market goes down, you take all of the loss. And when it goes up, you get all of the gain. But for that, you pay a fee all of the time. If you think that's okay, then that's okay. If you say, look, Arif, I pay $2,000 a year in fees, and I'm willing to do that if I receive $10,000 a year in gain, that's a good deal. We would take that. I'll give you 2 if you give me 10, right? That's a fair trade. But how about the client last week, Jeff? 49 plus 8, $57,000 a year in fees. $57,000 a year in fees. He was only taking out $60,000 to live on. So he's like, Arif, I don't even know where this money's coming from, because it just seems like no matter what, it comes. How hard is it? I have to swim upstream just to try to break even, because he's realizing $60,000 but paying taxes on it. And then his account balance is reducing by almost $120,000. Do you not see that, guys?
That's a lot of pressure.
It's, oh my goodness, the rate of return has to be just incredible just to try to get anything.
Well, and that's a big deal, because I think we've seen time and again, and more so lately, now that we've seen, what the market's done to a lot of our prospective clients' accounts, is they're coming in and they're showing us time and again that these companies and these brokers alike, it's not just the person that sold you that account or put the plan together for you. It's not just the company. Collectively, the fees are, in some cases, more than what the client is earning, and it's 100% of their money at risk. And they can only win 1 out of 3 times. So if the market's down and they lose money, they pay a fee. If it's flat and they don't make any money, they still pay a fee. But if it goes up, they make money. So 1 out of 3 times, and you take 100% of the risk. What is that, 33? A third percent of the time you can gain. So you better hope it's really big, is what I'm saying. And when you have big dollars going in, do people spend percentages or dollars? We've asked that question a bunch of times. You think 1% or 2%? Oh, that's not a lot. I made 40%. Wonderful. But you do that year over year over year, that percentage on a much larger dollar becomes a much larger number that goes out the back door. I think it just falls off people's radars too often.
There's a lot of behind the scenes that takes place in the financial world. Some of it's like the old adage, what was it, politics and sausage. You never want to see how it's made behind the scenes, because it's not something you would like. Well, I think sometimes the financial markets are very similar. People think things matter when they don't, because at the end of everything, it's, do I have more money than I started with at the beginning of the year?
Yes.
Or at least do I not go backwards? Number one. Number two is, when I take this money out of my account, is there anybody that is part of my team, if you will, advisory team or professional financial team? It could be your CPA, it could be your insurance professional, it could be your financial professional, it could be your estate planning attorney. One or all of them should collaborate, and that collaboration might be a 10-minute conversation once a year. It doesn't, if you're not that complicated, it doesn't have to be that big of a deal. Or it could be a full sit down and an hour meeting where everybody's sitting and kind of strategizing. It depends on your own personal situation. I encourage you to seek out the advice of those professionals. But no matter what that team says, are they looking out for your best interest? Or do you think that you have to have somebody that has a whole bunch of initials after their name, and then you're supposed to close your eyes and trust them with everything that you've worked your entire life for? And when you call, they're at the golf course, or they're, sleeping in, or went home early today. I think if you're paying a fee, you should get something for it. What? I don't know. You have to decide what you're willing to spend money on, but think about it in the sense that when you're ready to pull money out, are they considerate of the tax situation you're going to be in? And is there something they can do? Sometimes there isn't. But is there? And that's where we transfer the risk, if you will, or at least the conversation about that over to that professional team.
It's something's just dawning on me at the moment here. Paying fees while we're talking about the accumulation of money and we're trying to grow our money. We think we're paying a fee for it to be grown, or at least for the oversight of that financial professional. What I mean is, look, if I park my money in this company based on your recommendation, I'm going to pay you a fee, you the broker, the company, okay, fantastic. What am I getting for that? But now think about that whole time you've paid fees and now you retire. Did they do something, they collectively, whether it's your professional, the person taking the lead here, or the company, did somebody look out for you and say, look, we're going to reduce the fees now because you don't really need to grow your money anymore. You've made enough money now. You have enough to retire. Why are they still charging you fees? When there are so many ways that you can just, if you're just pulling money, and that gentleman you're talking about a minute ago, where he's pulling out as much, or he's being feed as much as he's pulling out of his account, he could basically live on 100% more income if he just parked it in a bank and started pulling that money out. So I invite people to start questioning some of those things that we just take for granted as normal, because it doesn't have to be that way.
When we come back, I want to get into what is it going to take strategy-wise with the taxes and how you're pulling money out in order to retire. Like, what does that look like when you're having the tax conversation, coming fresh off of our tax season, if you will? How do we make sure that when you're preparing to retire, you're not going to give half of it away? We have that and a whole lot more. I'm Arif Halaby, along with Jeff Girard, on your place for news, talk, and information. This is AM 1220 KHTS.